The 2008 stock market crash was a period of financial turmoil that occurred during the late 2000s. It was triggered by the collapse of the U.S. housing market and the subsequent failure of several major financial institutions. The crash led to a global recession and a sharp decline in stock prices. The Dow Jones Industrial Average fell by more than 50% from its peak in October 2007 to its trough in March 2009. The S&P 500 also fell by more than 50% during this period. The crash was caused by a combination of factors, including lax lending standards, a lack of regulation, and overvaluation of assets. The government's response to the crisis included the Troubled Asset Relief Program, TARP, and the American Recovery and Reinvestment Act, ARRA, of 2009. The 2008 stock market crash was a global financial crisis that occurred in 2008 and was caused by a combination of factors, including a housing market bubble, lax lending practices, and a lack of regulation of financial institutions. The crash led to a sharp decline in stock markets around the world and a recession that lasted for several years. The crisis also had a significant impact on the global economy, leading to widespread job losses and economic hardship for many individuals and families. The U.S. government intervened by approving the Emergency Economic Stabilization Act of 2008, which created the Troubled Asset Relief Program, TARP, to purchase distressed assets from financial institutions, stabilize markets, and ultimately help restore economic growth. The 2008 stock market crash was caused by a combination of factors, including the housing market bubble. The housing market bubble in the lead-up to the 2008 stock market crash was characterized by a significant increase in housing prices that was not supported by underlying economic fundamentals. This bubble was caused by a number of factors, including 1. Low interest rates. The Federal Reserve kept interest rates low, making it easier for people to borrow money to buy homes. 2. Lax lending standards. Banks and other lending institutions relaxed their standards for issuing mortgages, making it easier for people to get approved for loans. 3. Risky loan products. Financial institutions began offering risky loan products, such as adjustable-rate mortgages and interest-only loans, which allowed people to qualify for larger mortgages than they could afford. 4. Speculation. Investors, seeing the potential for profits, began buying up multiple properties with the expectation of reselling them at a higher price. 5. Lack of regulation. Regulators failed to intervene to prevent the bubble from growing and eventually bursting. All these factors contributed to the housing market bubble that ultimately led to the 2008 stock market crash, as the bubble burst and housing prices dropped dramatically, causing defaults, foreclosures, and leaving many homeowners and investors with underwater mortgages. Lax lending practices. Lax lending practices were a significant factor in the lead-up to the 2008 stock market crash. These practices included issuing mortgages to people with poor credit, low income, or no documentation of their income, and approving loans that borrowers could not afford to repay. Some of the specific practices that contributed to the crisis include 1. No documentation loans. Also known as liar loans, these mortgages required little or no documentation of a borrower's income or assets, making it easy for people to qualify for loans they could not afford. 2. Low or no down payments. Many loans required little or no money down, allowing borrowers to purchase homes with little skin in the game and increasing the risk of default. 3. Adjustable-rate mortgages. These loans had low initial interest rates that would later adjust to higher levels, making payments unaffordable for many borrowers. 4. Interest-only loans. These loans only required borrowers to pay the interest on the loan, not the principal, making the payments affordable in the short term but increasing the risk of default in the long term. 5. Subprime loans. These loans were issued to borrowers with poor credit, who were often charged higher interest rates than borrowers with good credit. These lax lending practices allowed many people to buy homes they could not afford, which contributed to the housing market bubble and ultimately led to the 2008 stock market crash when the bubble burst and housing prices dropped dramatically. Lack of regulation. Risky loan products were a significant factor in the lead-up to the 2008 stock market crash. These products, which were often bundled together and sold as securities, included mortgages and other loans that had a higher risk of default. Some of the specific types of risky loan products that contributed to the crisis include: 1. Mortgage-backed securities, MBS. These securities were created by bundling mortgages together and selling them as investments. Many of the mortgages included in these securities were subprime or otherwise risky loans, which increased the risk of default for the securities. 2. Collateralized debt obligations, CDOs. These securities were created by bundling together different types of debt, including mortgages, credit card debt, and auto loans, and selling them as investments. Many of the debts included in these securities were subprime or otherwise risky loans, which increased the risk of default for the securities. 3. Credit default swaps, CDS. These were a type of derivative, which essentially were a type of insurance for investors in securities such as MBS and CDOs. They allowed investors to protect themselves against default, but they also increased the overall risk in the system as they were often used to speculate. These risky loan products allowed financial institutions to spread risk across multiple investors, but when the housing market bubble burst and housing prices dropped, many of these securities became worth far less than their original value, causing widespread defaults, foreclosures, and a decline in confidence in the market and financial institutions. Complex financial products. Complex financial products, such as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, were a significant factor in the lead-up to the 2008 stock market crash. These products were created by bundling together mortgages and other types of debt, and then selling them as securities to investors. The complexity of these products made them difficult for investors to understand and evaluate the risk, which led to a lack of transparency in the markets. Some specific ways that complex financial products contributed to the crisis include: 1. Lack of transparency. The complex structure of these products made it difficult for investors to understand the underlying mortgages and other debts that they were investing in, which made it difficult to assess the risks. 2. Misaligned incentives. The complex structure of these products also created misaligned incentives for the financial institutions that created them. They had an incentive to originate and package as many mortgages as possible, regardless of the borrower's ability to repay, because they made money from the origination and packaging process. 3. Spread of risk. The complex structure of these products also made it difficult for investors to identify and assess the risk of investing in these products, leading to a widespread spread of risk across the financial system. 4. Difficulty to value. These complex financial products made it hard to value their worth, which increased uncertainty in the markets and decreased trust in financial institutions. All these factors contributed to the market crash, as the complexity of these products made it difficult for investors to understand and assess the risks, which led to a lack of confidence in the markets and financial institutions. Over-leverage. Over-leverage, or taking on too much debt, was a significant factor in the lead-up to the 2008 stock market crash. Many financial institutions, such as banks and investment firms, had taken on large amounts of debt in order to increase their returns on investments. This over-leverage made these institutions vulnerable to market downturns, as a small decline in the value of their assets could cause them to default on their debt. Some specific ways that over-leverage contributed to the crisis include: 1. Risky investments. Financial institutions used debt to make riskier investments, such as subprime mortgages, in order to generate higher returns. 2. Lack of liquidity. Financial institutions had borrowed large sums of money to make investments, which left them with insufficient cash on hand to cover their obligations in case of a downturn. 3. Complex financial products. The use of complex financial products, such as mortgage-backed securities and collateralized debt obligations, also contributed to over-leverage as they made it difficult to assess the risk of the institution's portfolio. 4. Interconnectedness. Financial institutions had become increasingly interconnected through complex financial products, derivatives, and other forms of leverage, which meant that when one institution failed, it put pressure on others, leading to a domino effect. The overleverage of these institutions made them vulnerable to market downturns and increased the risk of defaults, which ultimately led to the 2008 stock market crash as the financial institutions failed and the market crashed. In summary of this video: 1. Housing market bubble. The housing market had been experiencing a bubble for several years, with prices rising to unsustainable levels. 2. Lax lending practices. Banks and other financial institutions had been issuing mortgages to people who could not afford them, often with little or no documentation. 3. Lack of regulation. Financial institutions had been engaging in risky practices with little oversight from regulators. 4. Complex financial products. The use of complex financial products such as mortgage-backed securities, which bundled mortgages together and sold them as investments, contributed to the crisis. 5. Overleverage. Many financial institutions had taken on too much debt, making them vulnerable to market downturns. All these factors together created an unstable environment that ultimately led to the crash of the stock market in 2008. It's important to note that making money in the stock market is not guaranteed, and there are many risks involved. It's crucial to conduct your research, consult with a financial advisor, and have a proper risk management strategy in place before investing in the stock market. If you want to learn more about stock market, like how to earn money from stock market, types of trading and effective strategies for trading, subscribe our channel. You can also open Demat account if you are new into stock market. Open with MarketWolf broking app for special rewards. And low brokerage fee. Consider with Angel Broking app, India's most trusted app. All links are in description.